Welcome to The Explainer. Today, we're diving into a story that kicks off with a military seizure out on the open sea. But believe me, it ends with a massive tectonic shift in the entire global financial system. Okay, so this is the huge idea we're going to unpack today. The headlines you see about ships getting seized, that's just the tip of the iceberg. The real story, the one that matters, is about a much larger, invisible crisis happening deep inside the hidden plumbing of global finance. So let's start at the source of the incident. Our story kicks off with a very real flashpoint. It's April 19th, 2026. We're in the incredibly tense waters of the Gulf of Oman. After a 6-hour standoff, the U.S. Navy destroyer, the USS Spruance, fires its main gun. Now, it's not trying to sink the ship, but to disable an Iranian vessel called the Cheskirska. This isn't some theoretical threat. This is the first real kinetic enforcement of a new naval blockade. It's the single domino that starts a cascade felt all across the globe. So this incident is our starting point. But you might be wondering, why does this one seizure matter so much more than any other? Let's break down the specifics of why this single event basically lit the fuse on a global powder keg. To really get the gravity here, you have to understand the context. The Tuesca wasn't just some random ship. No, it was a known bad actor, a sanctioned vessel with a long history of illicit trade. And its cargo, well, it wasn't crude oil. It was sodium perchlorate. We're talking about a critical precursor for solid rocket propellant, a key ingredient for Iran's missile program. The U.S. Navy's action was the first real test of a full-scale naval blockade of Iranian ports that had just been announced a few days earlier. This was a calculated, deliberate move in a much bigger geopolitical chess game designed to send a crystal-clear message and disrupt a critical military supply chain. So this single event immediately triggers a global problem. Because it's not just about one ship, it's about the waterway it was in. The blockade creates this massive, immediate hole in the world's energy supply. And this is the number that changes absolutely everything. With the Strait of Hormuz effectively closed to commercial traffic, major producers, we're talking Saudi Arabia, the UAE, Iraq, Kuwait, Qatar, they are all choked off from the global market. And the result is that 12.4 million barrels of oil every single day just vanish from the global system. That supply isn't just delayed. For as long as the blockade holds, it's gone. To put that number into perspective, the world uses roughly 100 million barrels of oil a day. This single blockade removes over 12% of that supply, overnight. This is not a ripple in the market, it is a tidal wave. It's a physical supply shock of historic proportions. Sure, it sends energy prices soaring, but it also sends shockwaves through every single industry that relies on transport, from manufacturing all the way to agriculture. But here's where we get to the real story, the part that nobody's talking about in the headlines. This crisis isn't just about a lack of fuel for your car or for container ships. It's about a lack of financial collateral for the entire global banking system. The physical oil is just one part of the story. The financial shadow of that oil is where the real crisis unfolds.
Now, to understand this, we've got to talk about the eurodollar market. And don't let the name fool you. It has absolutely nothing to do with the euro. It's just a massive, multi-trillion-dollar pool of US dollars held in banks outside of America, beyond the direct control of the Federal Reserve. You can think of it as the global financial system's huge, unregulated backup generator. It's the system that creates the vast majority of the dollars, or liquidity, that actually funds international trade. And what keeps this massive generator running smoothly? High-quality collateral. And you know what? There is almost no better collateral in the world than physical oil, loaded onto a supertanker ready to be delivered.
And this is the financial chain reaction. The blockade instantly removes 12.4 million barrels of oil per day. But that's not just oil. That's trillions of dollars worth of high-powered collateral that was backing a mountain of financial instruments, derivatives, swaps, loans. When that physical collateral vanishes, all those financial positions are suddenly exposed. It triggers a system-wide margin call, a frantic scramble by banks, commodity traders, and corporations all over the world to get their hands on US dollars to cover their bets. This creates what's called a liquidity gap, a black hole where dollars used to be. The cost to borrow dollars skyrockets, and the real explosion isn't in the Gulf of Oman, it's deep inside the financial plumbing of the world. So what happens when the main system, the formal, regulated, dollar-based system, becomes paralyzed or just way too expensive? Does trade just stop? No way. It finds another way. It goes into the shadows. And this is where we see the rise of the dark swap. This slide basically shows a complete parallel financial universe that has popped up to fill the void. On one side, you've got formal maritime trade, relatively new ships, totally transparent with their tracking systems on, insured by major Western firms, and settled in US dollars. On the other side, you have this totally different beast, the dark swap. This is a world of aging tankers, often over 25 years old, operating with their tracking systems spoofed or just turned off entirely. They're uninsured by the West, and they settle their trade not in dollars, but in local currencies, cryptocurrencies, or even direct barter. It's a system built for one thing: opacity. It's designed to survive outside the reach of sanctions and the dollar. And this right here shows you that the financial blockade is arguably even more powerful than the naval one. Before the USS Spruance ever fired a shot, Western insurance companies, specifically the powerful London-based clubs, had already acted. They jacked up their war risk premiums for the Strait of Hormuz by 40 times. A single voyage that might have cost $40,000 in insurance suddenly cost $6 million. It just became economically impossible for any legitimate, publicly traded company to go through the strait. The insurers effectively closed the waterway before the Navy even could. So who fills this power vacuum? Say hello to the Ghost Fleet. We're talking about a massive, sprawling armada of old, questionably maintained tankers operating completely off the grid. And listen, this is no small-time smuggling ring. This fleet now moves up to 17% of all seaborne crude oil, including a steady 1.3 to 1.6 million barrels per day of sanctioned Iranian crude that never stopped flowing. This fleet has become a permanent, systemic feature of the global energy market, creating an entirely parallel trade architecture that reroutes liquidity and power away from Western control. Okay, so this is all fascinating, big picture stuff, but how does this crazy global drama actually impact the average person? Let's bring this all back down to a practical, and frankly, a brutal truth for retail investors who are just trying to trade this crisis from their brokerage accounts. Let's talk about something that drives countless investors crazy during an energy crisis. You see the headlines, right? Oil prices are screaming past $100, $120, $150 a barrel. It seems like the easiest trade in the world. You buy a popular oil ETF to get in on the action, but then you check your account a month later, and you're shocked to see your investment is actually down. How is that even possible? The answer has this weird name, contango. It sounds complex, but the core idea is pretty simple. It's when the market expects oil to be more expensive in the future than it is today. Now, because your ETF doesn't own physical barrels of oil in a tank somewhere, it owns futures contracts, promises to buy oil at a set price on a future date. To stay invested, it has to constantly sell the contract that's about to expire and buy the next month's contract. In a contango market, this means it is structurally forced to sell low and buy high, over and over and over again. This process is what creates the trap, and they call it negative roll yield. I want you to think of your investment as being in a leaky bucket. Let's say the ETF holds the July contract, priced at $100. As July gets closer, it has to sell that contract to avoid, having millions of barrels of oil delivered to its doorstep. But because the market is in contango, the August contract it needs to buy is more expensive, say $102. So the fund sells at $100 and immediately buys back at $102. It just lost $2 per contract, simply to maintain its position. This happens every single month. It's a constant mechanical drag that just drains value from your investment, even if the spot price of oil is going to the moon. And that's the brutal truth. This structural flaw acts like a hidden tax on your investment. During this crisis, that negative roll yield is costing investors in these popular ETFs between 15 and 20% of their principal. They can be right about the direction of oil prices, spectacularly right, and still lose a significant amount of money. It turns what looks like a surefire bet into a structurally losing proposition over time. All right, so let's pull all these threads together. We started with a physical ship being disabled, which created a 12.4 million barrel per day hole in the oil supply. But the real story was the much larger liquidity gap this created in the global financial system. We saw how a financial blockade driven by insurance companies proved even more powerful than a military one. And this, in turn, fueled the explosive growth of a parallel dark swap trading system, a ghost fleet now moving a huge portion of the world's oil. And finally, we brought it home, showing how the average person trying to invest in this crisis often falls into a structural trap, paying a hidden tax that eats away at their returns. And that leaves us with this one final and kind of scary thought. The engine room explosion on the Tosca? That was just the beginning. The crisis has transformed a physical choke point into a deep financial fault line, forcing trillions of dollars in trade and liquidity into an opaque shadow system. As this new architecture solidifies, we have to ask ourselves, who really controls the flow of money and goods in this new world? The real fallout from this event is still spreading, reshaping the international monetary order in ways we are only just beginning to understand.